Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like I normally do, share what I'm seeing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there, take a look, see what people are sharing. If you want to follow me at _finance, and if you want to join our community, finding-value.com, that's where I dive deeper into all these topics, looking for potential investment opportunities, helping people figure out how to navigate these markets, macro environment, looking for potential investment opportunities in individual companies, showing you what I'm doing, how I'm doing it, and all that stuff. So if that sounds interesting, we have a coupon code special. That's the coupon code that you can use for some savings on a monthly and or yearly membership. Starting off with Logan, I like Logan. He seems like he's got a good head on his shoulders. He seems like he can read the data pretty accurately. And that's kind of where I migrate. I don't migrate to these other people who are doomers that just doom all the time. A lot of the doomers do get a lot more views, but they're not right. That's where I have to draw a line in the sand. It's like, well, who's looking and interpreting the data correctly? That's really what matters. I'll be a bear when it's time to be a bear, and I'll be a bull when it's a time to be a bull. And you have to read the data correctly. If you cannot read data correctly, and whatever you read in life from all of these different inputs of information, if you're not reading them correctly, your outcomes will be wrong, your outcomes and your conclusions. So Logan says, yes, your bearish take on America has been wrong for years, and it will be wrong for years because we don't have inventory. Inventory is like the end-all be-all. And you could say that we have bubble-ish characteristics in certain metrics, but I would say this: it can't be characterized as a bubble when you have no inventory. So in order for the market to clear, it needs to be priced higher, and the median buyer needs to be priced out of the market if we don't have homes for the median buyer to buy. Like, if they don't exist, I don't know how what they're looking and the conclusions they're making makes no sense to me. If we need to price out the median buyer because the homes don't exist for the median buyer to buy, then the affordability needs to be raised to a level where the median buyer gets priced out. So this one here is, notice anything about 2001 and 2008, and these guys are going back and forth, I think. And this is 2001 and 2008. This is multiple job holders as a percent of employed. I don't know what she's actually getting at here. Multiple job holders. I don't know how this works with anything in the housing market. Moving on. RevCap. Everyone is losing their mind about trying to flatten the slope of this by like 1% a year, as if not doing something is an option. So this is the U.S. federal debt as a percentage of GDP, Congressional Budget Office projections, up, 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 up. This is also one of the reasons that we could get stagflation. This is a driver. As they continue to print more money to fund higher federal debt, the deficits, so to speak, as our deficits as a percent of GDP, I think we're running like 8% right now. That's what happens. And if interest rates continue to go up, your interest expense continues to go up too, and that will blow out to the upside. That money comes into the system. It's demand. It looks to buy things, and it isn't a final payment. So it's going to continue to look to buy things, be demand. And if GDP, aka oil, cannot grow as fast as this out in the future, you've got a massive problem with the design of your system in relationship to the reality of the world. That's why I'm so bullish on oil. In fact, I am so bullish on oil and the situation of this debt problem that we are in that it makes me ultra bullish on precious metals. And what that is that if there's a mismatch between this growth and the growth of GDP, that will result in inflation. If we hit problems, which I think we will, in oil delivery or energy delivery, and that grows way faster than energy inputs to the system, we are going to get massive inflation. In fact, the inflation could be so bad that we see a spike in interest rates. The spike in interest rates are going to force and move money out of multiple asset classes, the financial assets. It would be moving out of the bond market, which it's already doing, and it could come out of the stock market. It's going to look for a home, and that home, I think, will be precious metals. If people get scared enough, it could be quite rapid. So I think that's going on, and we're at the beginning stages of gold, which is already broken out. We've broken out on silver, but it hasn't broken out of its $35 an ounce level. That's going to blow through 35, and then we'll probably be at $50 to $100 in heartbeat, something on the lines of that. And the driver of it is this. This is the ultimate driver. The other driver is GDP not being able to keep up, which puts the whole system at risk because of the design of the system. And that's what makes me ultra bullish on physical metals. And if you're part of the website, you guys know that already. You know I'm a ultra bull on physical metals, gold, silver, everything, all of it. I like everything. Silver Chartist says uranium is carving out a major low. In my humble opinion and present, the most favorable risk reward setup of any sector I track for those with the 6 to 18 month time horizon. So he's jumping on the uranium train. I actually think uranium looks pretty good right now. I agree with him. Here's his low area here, the stink bid trend line. And yeah, I think it's a good entry point. I agree. March U.S. crude oil production is done. No uptick following the recovery in production in February. EIA will report a headline production of 13.4 million barrels per day, when the reality is it's closer to 13.1 to 13.15 million barrels. So we are flatlining. If you go back into 2023, we've been running at about 13.4, 13.5 the entire time, and we could be declining soon. You can see that we've been chopping back and forth since December 2022. We're chopping back and forth. Is that a function of price or is it a function of geology? That's the most important distinction that we're trying to figure out. If it's a function of geology, price won't matter. Price can go up and we will still not raise this production all that very much. That happened in 1970 in conventional production in America. What occurred? We hit peak oil in 1970 for conventional production in the United States of America. They added a buttload of drilling. I'm talking like many multiples of what we were drilling before, they added on top of it. Guess what happened? Production declined. So I think that the response will be the same. I think we'll probably drill like heck. Production will still decline if it's geology constrained. And I don't know if it's geology constrained. We have low pricing right now, but my guess is that it is. It's becoming more geology constrained with time, and eventually we'll see if it does roll over. If this rolls over, that's where the majority of growth came from, and it's going to be a rough ride for oil. Peter Schiff says the Trump administration doesn't understand how much government, consumers, and financial markets depend on the global subsidy of low-cost imported goods. They are the foundation of our house of cards economy. Once it topples, removing the tariff won't put it back together again. I mean, that's Peter's opinion. I don't know. I'll just say I don't know. I know that we don't produce a lot of things here. And maybe the tariffs are trying to bring things back so we can produce here. Will it work? I don't know. And I'm against more taxes. Tariffs are just taxes on us. If there's a way that we can do this where we can somehow try to figure out solving this big problem here, and at the same time reduce taxes, that's where I would be at. The problem is there's a lot of stuff in this system that I don't know how you're going to get rid of it. It deals with obligations that the government has made. Historically has made obligations to people, Medicare, Medicaid, all these different things, and pensions, government pensions. There's all sorts of stuff. I don't think they're going to do anything. I think we're going to go into a massive inflation. That's what I think. Amy Nixon says over 70% of U.S. households cannot afford a median-priced home. Buyer pool for your 750,000 McMansion isn't very deep, friends. I don't know how they do this calculation. So I was looking at this. It says figure 1, U.S. households in millions buy highest priced home they can afford. How do they know what people can afford? Is it based off of their net worth? Is it based off of, are they looking at only people who don't own homes? Are they looking at everyone who owns a home? I don't know how they calculate some of this stuff. I don't agree with what this is saying. Over 70% of U.S. households cannot afford a median priced home, but yet 40-something percent of homeowners own their house outright. So I'm not exactly sure how they do this. How can over 70% of U.S. households cannot afford a median priced home when 40% of people own their house outright? And I'm not sure what percentage of that 40% makes up of U.S. households percentages, but I highly doubt that this number is correct. Now, are they only looking at income and assuming that they don't have any net worth? So I don't think this is a right metric. I'm in a house. I can afford my house. My brother can afford it. There's a lot of people. My parents have low income, but they own their house. Do they count in this? I don't know. I don't know how legit these metrics are. Gold. We've long been gold bulls, but starting to look extreme here. And they're looking at the distance above the 50 and 200-day moving average. They're also looking at what could be the relative strength indicator down here, or I should say the rolling 200-day Z-score, which is pretty high. Could we get a pullback? It's possible. Would I sell? No, I wouldn't do anything. We're in a bull market. One of the famous sayings from Jesse Livermore's book, I think his name was Old Mr. Partridge, was his name. All he would say in it is, well, we're in a bull market. That's kind of what I'm going to use right here. Well, gold's in a bull market. Why would you sell it? Why would you lose your position here? Stay long is my opinion, is what I'm going to do with the gold that I do own. And I'm going to stay long in it and not worry about being overvalued in some rolling 200-day Z-score. I'm not going to worry about the distance above a 200-day moving average or the 50-day moving average until we get to a level where gold becomes overvalued against other assets. And we are so far from that even if I get a pullback in the short term, I don't really care. It just doesn't matter to me. A lot of people ask me about, when am I going to exit something? When is it time to sell? When are we going to leave? And I kind of say, I don't know if it really matters. I say, what do you mean if it doesn't matter? Guys, when you ride this from these levels so low, let's say you bought a bunch of gold. You bought a bunch of gold at $1,200, $1,300, and you're riding it. And now we're at 3,000 something. If we go to 10,000 or $15,000 or $20,000 and you don't nab the last $500 or $1,000 on it, does it matter? Like, does it matter? What if you put a bunch of money in there and you made so much money that at some point it's just a measuring stick? That's all it is. And if you're in this game of compounding and you've compounded enough years, the ultimate value isn't really going to increase your standard of living at some point. So yes, does it matter if you're up and you've made 10, 20, 30, 40, 50 million dollars? Does it matter if you get to 100 million versus 50 million? I don't know. The whole goal, we're buying so low here, it is ridiculous. We're buying at the bottom of patterns. They're double bottom patterns. They're falling wedges at the bottom. The ratios are so incredibly cheap. It is stupid, ridiculous cheap. And if we get anywhere near a peak of those ratios, your returns are going to be so ridiculous that I don't know if it will matter if you eke out the last 20 or 30% or 50% out of it. But right now we're early. The valuations are all jacked up. There's no way that I would do anything in the short term with gold right here. In fact, when I look at the gold price starting to go vertical and you get these overvaluations, I'm at the point where it's like, is there something wrong? Does the market think that there is something wrong with our debt situation? Is it so bad that I should start to panic buy in everything? You know, panic buy silver, panic buy platinum, panic buy anything that's of a hard asset. I've already kind of done that to some degree, but at some point this could turn. This rolling 200-day Z-score could go off the page because of the dollar value, the DXY. Or not, I shouldn't say DXY, but just the value of the dollar. And there's some more down here that we'll talk about there. It says, Spencer says, great news. The White House doesn't know what the hell they are planning to roll out in a few hours from now for our Liberation Day. Just completely winging it. Nobody is embarrassed of this. So this is the article. It says, the White House has not reached a firm decision on their tariff plan, said the people, who spoke on the condition of even though Trump himself said earlier in the week that he had settled on an approach. Guys, I'm not pro or anti-Trump. I don't really care. But if you're going to run a country, you got to have a plan. There's got to be a strategic plan. If this goes for everything. If you're going to run a basketball team, a baseball team, you're going to run a group of people or a facility in a manufacturing facility, you need to project a strategic plan and stick to the plan. If the plan is bad, then swap the plan for something else and tell everyone this plan it's not working. We've given it time. We're going to switch and go with a different plan. To inject uncertainty like this into the market is really hard for the market to digest. It hates uncertainty. A lot of people hate uncertainty. So what I would say or give it a suggestion would be, don't be so uncertain. Pick left, pick right. It doesn't really matter. If it doesn't work, change your decision and then go in the opposite direction that you were going. But that's my opinion there, and uncertainty is a killer for the markets. ISM indexes, lead indicators. ISM new orders is down quite a bit. That is looking pretty rough here. Could that be a recession? It could. But here's the problem. What people think is that when we get these moves lower, like back here, that we get a big pullback in the market. That very well could occur, but you have to pair that with what we went up over here on this debt. Money's flooding into the system. So could we get a stagflationary environment? We could. And it may look different than previous recessions. All these recessions may not look the same. We could get a recession and have interest rates go up. I know it sounds weird. And that could distort the yield curve. It could distort all sorts of stuff. And people are using the old playbook, trying to use the old playbook and put it to what we are in today for the conditions we are in today. All I'm going to say is what we are in today is a little bit different market condition than what we've seen in past. And we could see a lot of money printing that distorts things. It may not go down nominally. It may go down in a ratio. Maybe gold outperforms the S&P 500 and the S&P 500 goes sideways. Maybe. Here's Logan. He says, purchase application data update. It's the first positive spring year in applications in many years. We are plus 2% week to week. We are plus 9% year over year. All this is happening with mortgage rates now not below 6.64%, which was when this data line used to improve in previous years. So mortgage purchase applications for 2025 is starting to move on up. And we've got seasonality. This is a good time this is the time where a lot of people start buying stuff. April, May, June, July, all through there. Dave Kranzler. So here's his opinion, and this ties in with that first or second chart I was showing up above. The dollar is doomed. A big credit crisis is unfolding in the United States and globally. If the Fed central banks go Weimar, Germany hyperinflation, gold goes to $50,000 minimally. See the chart of it in 1920 to 1923 if you're skeptical. No printing equals a fiat currencies go to zero. See my price target above for gold. Also note, so the gold price is starting to scare me. What does it know? And Dave Kranzler's talking about this big credit crisis. And if they go Weimar on it, we get this big surge higher. So how do you know who's right? How do you know if we're in a crisis? Gold's going vertical. Peter's like, hey, this kind of scares me. It scared me too. No doubt it scares me a little bit. I go and I look at it, I'm like, holy crap, this thing's going vertical. And it makes me think I need to buy everything I can that's a hard asset to get my wealth out of dollars. Another thing to think about is you can buy stocks, they're going to underperform, and you could buy commodity equities, but how do you unwind the trade? How do you unwind it out of your brokerage account into something else? And the delay between you selling it out of your brokerage account and buying something physical, if the if the dollar is going down fast enough, you have to unwind it very quickly. So I'm taking an approach where you might need some physical metals to protect your wealth, and also you have enough where you can leave your brokerage account just run, and you own those assets. So yeah, I don't know. I don't know if there's a certain price. If we just start going vertical, if that scares me enough to go buy silver and other things, I don't know. Go buy some food and stack it in the basement. I don't know. But yeah. If the Fed or central banks go Weimar Germany and inflate like heck, gold's going way higher. And that's where I don't want to lose my position. Tying it into Jesse Livermore and that book, it's Gold Mr. Partridge. We're in a gold bull market. And you don't want to lose a position. That's the biggest problem, is losing the position. So you want to keep that position on, whether it's overvalued or not overvalued, but the relative strength indicators at a high point, or the MACD is way up. I don't know if it matters anymore, guys. This is what I'm worried about. That's why I own it. I don't care about making a little bit of money. I need protection from the currency. What does it mean that gold hit 3150 and yet gold juniors, even legit ones, are not reflecting this at all? That it's easier than anyone has seen in 40 years. Well, what I think it means is that money hasn't rotated yet. It doesn't mean that gold juniors are bad. And there's a strong demand for gold, for physical gold is also what it means. There's more demand for physical gold right now than there is for mining companies. Now, does it mean that the mining companies aren't going to follow? Miners have been so crappy for so long that the sentiment is going to take time to change. So what I'm going to do, I'm going to have some money allocated to it, just sit in it. Just sit. And again, go back. We're in a gold bull market. We're in a gold bull market. Just repeat that to yourself. We're in a gold bull market. Do gold juniors go up during gold bull markets? Probably, yeah. So I'll just sit and wait. Global commercial flights, we've got 7-week average for 2025 versus 2024. It's up 8.3%. 2019, it's up 21%. Year to date, we're up 7.2%. And for 2019, year to date, we're up 19.4%. So we are up on commercial flights quite a bit compared to previous years. Demand is not a problem. Oil, we're going to need a lot more oil. That's global commercial flights. Freight futures, AM update, dry bulk, Capesize is up 2%, Panamax down 3%, and tankers, VLCC is up 1%, Suezmax is flat. Here's Logan and Patrick Bet David. It says 6.1 million Americans are behind on their mortgage, the highest in 20 plus years. Brace for impact. And Logan responds with, what this week has shown already, and it's only Tuesday, is that doom porn charts with housing have limits before everyone realizes you're full of crap. These guys have no idea what they're talking about, but yet they're some of the most well-known people on YouTube. Interesting. This is probably multifamily delinquencies, by the way. Multifamily. And he doesn't even know it. 6.1 million Americans. He doesn't even know what the data is. Grady says, notice that precious metals miners did not follow the stock market down into the weekly cycle decline. Repeat, miners did not follow the general markets down this time around. Instead, miners changed character, went the opposite way, and with that, acted like a safe haven. S&P 500 down, look at GDX going up. That's what we're looking for. We're looking for the miners to kind of break away from the overall market. Be patient, guys. Patience is everything. That's how you make lots of money. You take an opposite bet of everyone else, and then you're patient enough for that bet to play out. You notice the small little intricate details, like GDX is broken away from SPX. You can also do that in a ratio. And GDX is starting to break out against the S&P 500. Money's starting to rotate into it at a faster pace than the S&P 500. That's why that ratio is bottoming and turning. Those are the things that you want to notice in the markets to give you an edge. Oil was up overnight, then BOE opened. Stocks started to crash. It's an algo. Everything was selling off. Yeah, it's an algo. Frank says, this man just destroyed the stock market on purpose. Trump's treasury pick set off a detox period to rewire America's economy. The secret, the crash is the perfect wealth building opportunity. When this crash ends in 90 days, there's one sector that sets to blow up 200%. I didn't read past this, so that's all I saw. It says, listen up because Wall Street's missing something massive. Bascent just dropped a bomb. They're completely rewiring the entire economy. And here's the kicker. They don't give a crap if markets tank during the transition. Bascent straight up said that there's no Trump put to save stocks. None. Zero. Instead, they're planning what he calls a detox period, and it's going to be brutal. This is unlike anything we've ever seen in my career. We're not talking about some small policy tweaks here. This is a complete overhaul of how America's economy works, moving from government handouts to raw capitalism. But Wall Street's too stupid to see the biggest risk. The detox period is going to absolutely wreck portfolios. Markets will bleed. Volatility is going to be insane. But Bascent let slip exactly when the pain ends. He called it the Trump call, and the timing is everything. To trigger new legislation. Johnson's pushing bills to Trump's desk by Easter or Memorial Day Once those pro-growth policies hit, everything changes, and smart money already is making their move. Pay attention because this is where real money is flowing. Regional banks are being bought up like crazy. Big money's piling into energy infrastructure. And crypto regulation plays. The smart money can't get enough. What Besant said blew my mind next. They're ripping off the Band-Aid completely. No more Fed bailouts, no more artificial support, no more government safety nets, pure capitalism. And if you want to survive, listen closely. And it goes on and on and on. But I'm going to end it there. Could there be an engineered recession? I called that last one. Yeah, could be. The detox period is that engineered recession. Lee says, cyclical as always, the U.S. economy has shifted towards late cycle dynamics, with energy, materials, and defensive sectors likely providing stronger returns. This is your cycle. Technology is starting to underperform energy. Energy is bottoming and turning up against technology. And what that means is that we're going from a recovery phase to an expansion phase. Expansion phase is where we go and more homes are built. We get inflation. It is more late cycle. Energy materials outperform during an expansion phase. And you can see the US circle here of where we're located. China and Canada are actually in, at least where they have it here, in the early recovery phase. China's definitely in recovery. And then you can see the Eurozone's more in recession. So we're in the late cycle, starting to enter the expansion phase, late cycle stage where energy starts to outperform. And this is also something that people may not know if all they're doing is charting things. This is generally the outperformers during this period of time. Every time the yield curve reverts, I think we went over this one last time, so I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel, subscribe to the website, use that coupon code SPECIAL if you'd like. And that's all I've got for today. So we'll catch you next time, guys. This is Finding Value.